Hi, everyone. Thank you for joining. I am Jordan Cardenas. I'm an employment attorney at Wagner, Falconer, and Judd, and our firm services the Compliance Center. And today we're going to talk about Minnesota Paid Family Medical Leave, or the short name, what the state calls it, Minnesota Paid Leave. So before we jump in, this little background about WFJ. So our law firm, we have about 37 attorneys, and then we have about 50 non-attorney professionals, so other legal assistants. And we were founded in Minneapolis, 1932, and we have offices in the Midwest, so Minneapolis, Wisconsin, Montana, and as of last year, now in Vancouver, Canada. So the agenda for today. So we're going to talk about who is a covered employer. So who has to comply with Minnesota paid leave, what employees are eligible for paid leave, and employees who are eligible, what are the qualifying reasons that they can go on leave for? And then we'll discuss different requirements. So, what are the state's requirements? What are the employer's requirements? What are the employees' requirements? And at the very end, if you don't like the state-run plan, we can talk about the private equivalent plan and talk about that option. So basically, you have an insurance carrier or self-insured, and you don't have to participate in the state-run Minnesota paid leave program. So what is it? Minnesota Pay Leave was actually passed in 2023, and what it provides is a state mandated paid family medical leave program that provides a partial wage replacement to employees who go on leave. So they don't receive their full pay, it's not unpaid, but based on how much they earn per week, they will receive a set amount from the state. And we'll talk about that later on. And employees have a qualifying reason it can go on leave. So if you have a family event, a medical event, so birth of a child, a serious health condition, those would be qualifying reasons. And then the program is funded by contributions, taxes. So the contribution rate for 2026 is 0.88%, and that is split between employers and employees. And we'll talk about that more in detail later on. Okay, so the effective date. In case you didn't know, the new law is now effective. It started on January 1st of 2026. So now you are required to start making those deductions from employees' pay. And employees can now go on paid leave for a qualifying reason and start receiving payment benefits from the state. So who is a covered employer? So basically, if you are an employer in Minnesota or have any employees in Minnesota, you are covered. So it covers all public and private employers with the exception of the federal government. So a very broad net. And then covered employees, same thing. Essentially, if you're an employee in Minnesota, you're most likely going to be eligible for Minnesota paid leave. So it covers full-time employees, part-time, temporary, and it covers most seasonal employees, unless those seasonal employees are in the hospitality industry. And we'll go through that exception later on. So essentially, all employees are covered and most will be eligible. But employees who are not covered would be seasonal employees in the hospitality industry, independent contractors, if you're self-employed, and then tribal nations and federal government employees. Now, independent contractors and self-employed individuals, they're not covered, but they have the option to opt into the program. Basically, they can voluntarily participate by paying premiums, and then they can receive benefits from the state. So, to be eligible, there's generally two requirements. So the first requirement is the employee has to earn 5.3% of the statewide average annual wage in the past year, which was $3,900 in 2025. So obviously that's a very low threshold, and 99% of employees will satisfy that. So that's the first prong. And then you have to satisfy 2A or 2B. So 2A would be you earned 3,900 in a year and you worked at least 50% of the time in Minnesota in a calendar year. Or if you don't satisfy that, you go to 2B and the employee does not work at least 50% of their time in Minnesota, does not work at least 50% of their time in any other state, performs some work in Minnesota, and the statute literally says some. So there's no quantifiable amount, but a strict interpretation of that would be, hey, if you work 1 minute, 1 hour in Minnesota, you probably satisfy the sum requirements, and you live in Minnesota for at least 50% of the calendar year. So obviously 2B, a little more complicated, much more fact intensive. So let's go through some examples. So I have 4 examples, and sorry, I'm not hiding the answers on the screen, but for all 4 examples, let's assume that the employee earned $3,900 in 2025. So then we're just going to focus on whether 2A or 2B applies. So first question, an employer does not have a physical office in Minnesota. So say they're in South Dakota and only has one employee in Minnesota who works remotely for at least 50% of their time in Minnesota. Is that employee eligible? And the answer is yes, because that employee works at least 50% of their time in Minnesota. So it doesn't matter that the employer doesn't have a physical presence. If that one remote employee works more than 50% of their time in Minnesota, they're going to be eligible. Example 2, you have an employee that lives on the Wisconsin-Minnesota border. The employee works 75% of their time in Wisconsin, works 25% in Minnesota, and then lives full-time in Wisconsin. Is the employee eligible? And the answer is no, because the employee works more than 50% of their time in a state other than Minnesota. So in this example, they work 75% of their time in Wisconsin. So Wisconsin claims them and they can't be eligible for Minnesota paid leave. Similar scenario. So employee on the Wisconsin-Minnesota border works 75% of their time in Wisconsin, works 25% in Minnesota, but this time, instead of living full-time in Wisconsin, the employee lives full-time in Minnesota. Is the employee eligible? And here the answer is still no, because the employee is still working more than 50% of their time in a state other than Minnesota. So it doesn't matter that they're living full-time in Minnesota. If they're working above that 50% threshold in Wisconsin or any other state, then they are not eligible. All right, last one. So the employee lives on the Wisconsin-Minnesota border. The employee works 40% of their time in Wisconsin, works 40% in Minnesota, and then works 20% in Iowa and lives full-time in Minnesota. Is the employee eligible? And the answer to this one is yes, because the employee does not work more than 50% of their time in Minnesota or any other state, but they perform some work in Minnesota, 40%, and then they live for full time in Minnesota. So they're satisfying that threshold of living more than 50% of their time in Minnesota. So that would be an example of 2B. So again, more fact intensive. They're not working more than 50% of their time in any state. They perform some work in Minnesota, in this case, 40%, and then they're living full time in Minnesota. So that's above the 50% threshold. So therefore, they are eligible. Okay, seasonal employees. So again, seasonal employees, they are eligible unless that seasonal employee is in the hospitality industry. So if they're in the hospitality industry, then there's a carve out for them, if making them not eligible if they satisfy these 3 requirements. So the employee has to be employed for 150 days or less in a 52-week period in a season or industry of hospitality. And that's defined as basically any food, beverage, lodging establishment. And then the employer's average receipts or revenue during any 6 months of the preceding calendar year cannot be more than 33% of its average receipts of any other 6 months of the year. So basically, it doesn't have to be 6 consecutive months. Just any combination of a 6 month period last year can't be more than 33% of essentially your revenue. So if those 3 prongs are satisfied, you can classify the employee as seasonal, and therefore they are not eligible and not covered for Minnesota paid leave. Now, if you intend to do that, if you intend to classify someone as a seasonal employee and not pay them, not deduct premiums, and therefore they don't get a payment from the state, you have to report the seasonal employee to DEED. So you must file a report to DEED if you intend to classify those employees as seasonal employees. and you can request that classification in your employer account. And we'll discuss this later on, but employers will have two accounts. They will have an employer account and then a Minnesota paid leave account. And the employer account, you submit your wage reports, among other things, and then you can also request a seasonal employee designation. Now, if you classify someone as seasonal, you also have a reporting requirement if they lose that seasonal classification. So if that employee loses their seasonal classification, you have 5 business days from the date they lose the classification, the exemption. You have 5 days to report that to DEED. So if they end up working more than 150 days in a 52-week period, they lose their classification, therefore they become eligible or likely eligible, and you have to report that to DEED. Or if for some reason they no longer work in hospitality, so say they change to a different branch or department at the workplace. So you also have notice requirements not only to the state, but you also have to notify your employees that you intend to classify them as seasonal. So for your current employees, you had to do this by December 1st of last year. And then for new hires, you have to notify them that you plan to classify them as seasonal employees at the time the employment offer is made. So not at the time of hiring. When you give them an offer or a conditional job offer, you have to notify them that they're going to be classified as a seasonal employee and therefore not eligible for Minnesota paid leave. And there is a model notice on the Minnesota paid leave website for current employees and new hires if you do intend to classify employees as seasonal. And then also with the notice requirement, the employees have to provide a physical or electronic signature on the notice that acknowledges that, hey, I got the notice and I acknowledge the receipt of it. And the template notice published by the state should have, or it does have, a signature block for the employee to sign. So it should already be built into the form. Okay, so you're a covered employer, you have eligible employees. Then the question becomes, what reasons can they use paid leave for? So there's two main reasons. So the first one is medical leave. They get 12 weeks for the employee's own serious health condition. And serious health condition, we'll talk about it later, but that's a defined term. And those of you subject to the federal FMLA, is essentially identical to the definition of serious health condition under the federal FMLA. And then you have family leave, so an additional 12 weeks. So you can take family leave for bonding time during the first 12 months after the child's birth or after the adoption or foster care placement of a child. You get 12 weeks to care for a family member with a serious health condition for active duty leave. So the family member is on active duty or they're ordered to active duty. And then finally, safety leave. So if the employee or the employee's family member is a victim of domestic abuse, sexual assault, or stalking. So you get 12 weeks for each, but you can combine them to a maximum of 20 weeks. So 20 weeks in a benefit year, and a benefit year is defined as a 52 calendar week period beginning on the first day employees take leave. Now, this is important because employers are not allowed to define the year. So if you're subject to the federal FMLA or ESST, you're familiar that you can define the 12-month period. So it can be a calendar year, employee anniversary year, rolling forward, rolling backward. But for Minnesota paid leave, you can't define it. The statute says a year is always going to be the 52-week period beginning on the first day of leave. So just be aware of that, because those of you that are subject to the federal FMLA, this could create some headaches where the two types of leave don't necessarily overlap because you have different definitions of the 12-month period. So when you do have a qualifying reason, it won't become a qualifying reason until that single event lasts for at least 7 days. So for a serious health condition, you have to be sick for at least 7 days before you become eligible for Minnesota paid leave, with the exception of bonding time with a newborn child or newly placed adopted child or foster care placement. That's automatically assumed a 7-day qualifying event bonding time. But for all other qualifying reasons, it has to be a 7-day event. And then every time the employee submits their application for paid leave, they have to provide a certification documentation. So if they need to apply for a serious health condition, they have to basically submit a doctor's note, or if they have to apply for bonding time, there will be other documents they can submit. And all the certification documents are on the Minnesota Paid Leave website. So employees can go online, get the applications or the certification they need, fill it out, and then they're required to submit it to the state to prove to the state that they have a qualifying reason. Now, again, bonding time, it's automatically assumed a 7-day qualifying event. And then later on, probably this year, the state is going to publish a list of certain health conditions that are automatically deemed a 7-day qualifying event. So maybe something like cancer or other diseases, but that list has not been published yet. But just knows that sometime in the future, the state is going to publish certain health conditions that will automatically be assumed to be a 7-day qualifying event. Okay, so a common question we get is, what if an employee had a child in 2025? Can that employee still take paid leave in 2026? And the answer is yes, as long as the employee is taking their leave within 1 year of the child's birth, adoption, or foster care placement. So for example, say you have a child or employee has a child on June 1st of 2025, that 1 year period to take the 12 weeks of bonding time will expire on June 1st of this year. So obviously you had a baby in June, paid leave didn't start till 6 months later in January. So January comes around, that employee can now take leave for a baby they had 6 months ago because they can complete the 12 weeks before June 1st of 2026. So theoretically, if they took a continuous amount of leave, they could take leave from January 1st, 2026 up until March 31st, 26, or as late as June 1st, 2026. However, they decide to use the 12 weeks. Now, a slightly different example, say you had a child on earlier in the year, so March 1st, 2025. That 1 year period to complete 12 weeks of leave would expire on March 1st, 2026. So instead of getting the full 12 weeks, you would be limited to 8 weeks starting in 2026, because if you took it January 1st, the 1 year deadline would happen 8 weeks later. So you still get leave, but the leave would be capped at 8 weeks. So kind of unfortunate, especially if employees got the Minnesota unpaid leave for 12 weeks or the federal FMLA unpaid leave for 12 weeks. Essentially, the employee gets the double dip starting in 2026. Okay, definition of a family member. So again, the employee can take leave for a family member's serious health condition, if the family member is a victim of some type of sexual abuse, or if the family member is on active duty. And the definition of family member is very broad. So it's essentially the same definition as the earned sick and safe time definition, is basically anyone related to you by blood. So grandparents, son-in-law, daughter-in-law, parents, siblings, obviously children. But then there's kind of a catch-all phrase that employers should be aware of. So one of the qualifying family members is an individual who has a relationship with the employee that creates an expectation and reliance of care without compensation, and the two do not have to live together. In other words, it can essentially be anyone that the employee designates as a family member. Okay, so serious health condition. I won't go too deep into this. We could spend 30 minutes talking about what constitutes a serious health condition, but I just wanted to flag that it is a defined term. And again, those of you who are subject to the federal FMLA are probably familiar with the definition of serious health condition. Now, employers that are just subject to Minnesota paid leave, you don't necessarily have to be super familiar with this definition because the state is going to decide whether the employee has a serious health condition or their family member. Whereas in the FMLA, the employer has to decide. Here at Minnesota paid leave, the state will decide. So not super important to know, but in case you think the employee is lying or you need to contest it or you just want to know more information, The quick definition is that, or high level definition, is that a serious health condition is a physical or mental illness, injury, impairment, condition, or substance use disorder that involves one of two things. It can be inpatient care or continuing treatment. Inpatient care, pretty simple. It's inpatient care in a hospital, hospice, or some other residential medical care facility where the employee is incapacitated or the family member is incapacitated. And then the second one's a little more complicated. So it could be something called continuing treatment. And there's five types of continuing treatment. There's incapacity and treatment, pregnancy or prenatal care, chronic conditions, permanent or long-term conditions, and conditions requiring multiple treatments. Now, each of these five kind of sub-definitions have their own examples and definitions you could go through. So if you have questions about it, just contact the Compliance Center. But I just want to do a quick highlight to show that these definitions exist and it might be worth being aware of in case the employee submits an application and you don't necessarily agree with it. So intermittent leave. So employees, obviously they can take their 12 to 20 weeks of leave, or excuse me, 12 weeks of leave continuously, but they also can take it intermittently if they want. So they can take intermittent leave for any qualifying reason under Minnesota paid leave. So serious health condition, bonding time, active duty, safety leave, that all can be taken intermittently. But the employer, you have to allow the employee to take up to 480 hours or 12 weeks of intermittent leave in a 12-month period. So you have to allow at least 12 weeks of intermittent leave. But then from weeks 13 to 20, you can decide whether leave is taken continuously or intermittently. So your paid leave policy, which we recommend, is in your employee handbook. We recommend having that paid leave policy, and then part of that policy, you should have a subsection for intermittent leave, and you should clarify saying yes, the first 12 weeks can be taken intermittently or continuously for any reason. And then from weeks 13 to 20, you, the employer, decides, hey, this can be taken intermittently from weeks 13 to 20, or it has to be taken continuously, or you can do some type of combination. It's up to you. And then your policy should also clarify the increment use. So can they use paid leave for intermittently for 1 hour, 4 hours? And with that, I would recommend that whatever increment use you use for earned sick and safe time, I would match that with Minnesota paid leave. So the two should match and just make it simple so employees know what the increment amount is. Okay, so now we'll get into requirements for the state, employees, and for employers. So the state will determine who is eligible for leave. So they're going to decide whether the employee earned $3,900 last year, whether they worked in Minnesota for at least 50% of the time. So that is not determined by the employer. And then the state will notify you and your employees whether the employee is eligible for leave. They'll notify you when the employee's benefit payments will begin, what is that benefit amount, and then how long they will receive the benefits. So that all should be sent to you in your Minnesota paid leave account, and we'll discuss that later too, what that account consists of. So the benefits paid to employees. So employees, Minnesota paid leave, this is a partial wage replacement program. So they're not going to receive 100% of their pay like they would for earned sick and safe time, PTO, vacation time. It's a set percentage. So they'll receive between 55 to 90% of their normal wage while they're on leave, and that is capped at $1,423. Now, the state has a fancy formula on how they calculate that. I won't go through that, but just know this exists, and we'll send out these slides after the presentation. And then SAWW, that is the state's wide average weekly wage. So the state applies this formula, and they get roughly these numbers. So employees who earn between $0 to about $700, they get paid 90% of their wages. If they earn between $700 to the $1,400 amount, they get paid about 66% of their normal wage. And then anything above 1,400, they get paid 55%. Again, that's capped at 1,423. So if you have an employee that's making $5,000 a week, they're not going to get 55% of that payment. They'll get the cap of 1,400. So employees' requirements, they have to apply for benefits online. And obviously, that is now active, so they can go to paidleave.mn.gov to apply. And then they have to provide certification to support the qualifying event. Again, the certification has to be provided for every single qualifying event. So bonding time, serious health conditions, safety leave. There's all these forms on the Minnesota Paid Leave website that the employer or the employee has to take, complete, submit it with their paid leave application. And then employers, you have the right to request a copy of that certification. So the employee is required to send it to the state first, but then you can request a copy. And then the law requires the employee to give you the copy of the certification within a reasonable amount of time. So what that is, obviously kind of gray, but they should give it to you as quickly as they can. And then they have to give or they have to report any additional weekly wages. And we'll talk about this later about supplemental benefits. So the employee will receive 55 to 90% of their wage, and that they are receiving vacation time, PTO, any other paid leave payment. They have to report it to the state because the state wants to make sure they don't receive more than 100% of their weekly pay when they combine their Minnesota paid leave benefit with any other form of paid leave from the employer. And then they have to give notice to the company if they want to use paid leave. So the notice requirements, very similar to earned sick and save time. So if the need for leave is foreseeable, the employee can give or must give at least 30 days advance notice. Earned sick and save time 7 days. Minnesota paid leave can be up to 30 days. But then for unforeseeable leave, they have to give notice as soon as practicable, which matches the earned sick and save time notice requirements. And then employers, you can't require a written notice. So the employee must be allowed to give notice either verbally, via phone, text message, basically in any type of manner that puts the employer on notice that they're taking leave. So just know you can't require a written form. You have to allow a verbal notification. Now, obviously, if they can do a written notice, that's great. You just can't require it. Okay, so employers' requirements. So we'll go through how employers have two accounts they need to have. So you need to have an employer account on the Minnesota UI website. You need to have a paid leave administrator account on the paid leave website, so a separate website. You have to designate a paid leave administrator, submit quarterly wage reports, finalize your company policies, so your Minnesota paid leave policy that we recommend be in your handbook. Certain notice requirements you have to give to employees, and then your premium obligations under Minnesota paid leave. So the first one, you have to create a employer account. Now this account's on the Minnesota UI website. And if you're already submitting UI reports, there should be nothing additional you have to do. So you should go online and you should see a Minnesota paid leave /UI account. And the wage reports that you submit for Minnesota UI will be the exact same wage reports that you submit to paid leave. The same report will be used to pay unemployment and for Minnesota paid leave. And through your UI account, you submit your quarterly wage reports. You pay your premiums for paid leave. So your premium is the employer and the employee's premiums. And then you have to designate a paid leave administrator. And essentially, this is the person, your point of contact for the state. If the state has questions about an employee's paid leave application, and then this person will receive the employee's application when they submit it to the state. So every time the employee applies for Minnesota paid leave, a copy goes to the state and a copy will go to the paid leave administrator for the company. Now, if you're an employer and you're some type of religious organization or a nonprofit organization, you will need to create a paid leave only account on the Minnesota UI website. So again, most employers, they'll have that joint account automatically created for them. But if you're not subject to Minnesota UI, then you have to manually create your own account called a paid leave account so you can submit your quarterly wage reports for paid leave purposes that way. So employer account, Minnesota UI website, and then you need a paid leave administrator account, which is on the paid leave website. So kind of confusing because on the UI website is where you designate your paid leave administrator, but then that paid leave administrator's account is created on a different website on the Minnesota paid leave website. So just be aware of that. And the paid leave administrator, they will review an employee's paid leave application submitted to the state just to make sure the employee is not lying, making sure they're not receiving more than 100% of their weekly pay, and just an extra eyes of oversight. And then you'll be able to view paid leave determinations by the state. So the state will say, yep, the employee is eligible. Here's the benefit amount, and here's how long it's going to last. So if you disagree, you could always contest it with the state. And then this is where you can request a equivalent private plan substitution. So if you don't want to participate in the state-run program, you always have the option to purchase a private plan or submit a private plan application, where basically your paid leave program is run through self-insurance or through a third-party insurer. We have a lot of clients doing that alternatively, so we'll discuss that at the end, discuss what are the requirements for the private plan. So the quarterly wage reports, again, you submit this on the Minnesota UI website, and it's essentially used for two purposes. It's used to determine the premiums you have to pay as an employer and the employee. And the first premiums will be due April 30th of 2026. Now, most employers, they're collecting the premiums now and then just sending them to the state and not waiting till the end of April. So that's fine. And then the state will use the wage reports to determine the employee's eligibility and determine the benefit amount to pay employees. So they'll look to see, based on those wage reports, did the employee earn at least $3,900 in the previous year? And did they work at least 50% of their time in Minnesota? So here are some due dates to be aware of. So these dates are the due dates for your quarterly wage reports and for the premium payments. So obviously each quarter, so you have April 30th, July 31st, October 31st, and January 31st. So that's the due dates for your wage reports and the premium payments paid to the state. Okay, so premiums. So obviously the paid leave program is funded through premiums, and the premium rate in 2026 is 0.88%. So as employers, you will collect the employee's portion through a payroll deduction, and then the employer's portion will basically be paid out of pocket. So the premium rate is for most employers, unless you qualify as a small employer, is 0.88%, and it has to be split no more than 50% between the employer and the employee. So usually that means the employee pays 0.44% and the employer pays 0.44%. So as an employer, you can always pay more if you want, but there's certain tax advantages and disadvantages to that. But you can pay up to 100% if you want as an extra benefit to employees. You just can't require employees to pay more than 50%. Now, another thing to be aware of is that say you do the 50-50 split, you apply the 0.44% premium, you have to make sure that premium does not put the employee below minimum wage. So after applying that premium, if you see that employees are now making below minimum wage, you then have to up your premium amount. So instead of 0.44, you might have to pay 0.5, 0.48, whatever the amount is to make sure the employee is not earning less than minimum wage. And there is a cap on the premiums paid, and that is the Social Security cap of $185,000 for employees. So again, 0.88%, that amount is the amount in 2026, and that applies to most employers. unless you qualify as a small employer. So as a small employer, instead of paying 0.88%, you pay 0.22%. Or excuse me, you pay 0.66%, but then your premium rate reduces from 0.44 to 0.22. So essentially it cuts it in half. So most employers pay the 0.88, but if you qualify as a small employer, it reduces it to 0.66. So then as the employer, you pay 0.22, and then the employee's portion stays at 0.44. Now, to qualify as a small employer, there's two requirements. You have to have 30 or fewer employees, and then the average wage of all your employees has to be 150% or less in the statewide average. Um, so in other words, your average wage per quarter has to be equal to or less than about $27,000. So if you satisfy those two requirements, you now have a reduced premium rate, and as the employer, you only have to pay your portion of 0.22 instead of having to pay 0.44. Indeed, they should notify employers through the mail or on your employer account what your premium rate is. So if you're wondering, it should be in that account. And when I've been told from the state, they are trying to send a notice to every employer what their premium rate is in 2026. Now, the premium rate, that's going to change likely every year. So the premium rate will be set every year by July 31st. So by July 31st of this year, we will know what the premium rate will be in 2027. So right now, obviously 0.88%, and then the maximum premium is 1.1%. So other requirements to be aware of. So employees who go on Minnesota paid leave, it becomes job protective leave if they go on leave 90 days after working 90 days at the company. So in other words, if the employee works 90 days, they go on Minnesota paid leave, they are now entitled to their job when they return from Minnesota paid leave. And then as the employer, you have to maintain the employee's health insurance coverage while the employee is on leave. But like FMLA, the employee is still responsible for paying their portion of premiums when they go on leave. And then, of course, you can't retaliate against employees. So employees that request paid leave or actually go on leave, you can't do any adverse employment action. So you can't demote them, you can't fire them, and you can't reduce their pay, etc. And another big thing is supplemental benefits. So supplemental benefits are payments an employer designates to an employee to make up the difference between the amount they're receiving for Minnesota paid leave to receive their full wage replacement. So in other words, a supplemental benefit supplements the paid leave benefit so the employee can receive up to 100% of their normal weekly pay. And the supplemental benefits can be any form of paid leave. So this could be paid vacation time, earned sick and safe time, PTO, disability insurance, what have you. Any type of paid leave can be a supplemental benefit, but the power to designate something as a supplemental benefit belongs to the employer. So as an employer, you have the option to say, hey, we're going to offer you PTO, earned sick and safe time as a supplemental benefit, therefore allowing the employee to take paid leave and some PTO sick time concurrently at the same time. And then they can combine the payments from both to receive up to 100% of their weekly pay. So as the employer, you have the option to offer it, but then the employee still has the option to either accept it or reject it. So the employee could say, that's great. I will use paid leave and PTO at the same time so I can get 100% of my pay. Or they can say, no, I don't want to use it concurrently. I want to save my PTO, save my earned sick and safe time, and I'd rather just get a partial wage from Minnesota paid leave, and then they're able to bank what other paid leave they have, PTO, vacation time, earned sick and safe time. So as the employer, you have the power to offer it, but you can't require that employees actually take it concurrently with Minnesota paid leave. And again, the supplemental benefit cannot exceed 100% of the employee's weekly pay. So the employee is getting a paid leave benefit and they get a PTO payment from the employer. That combined payment can't exceed 100% of the employee's pay. Now, these other laws, which are unpaid, the employer can require that employees use these leaves concurrently. So the Federal Family Medical Leave Act, you can require an employee to take FMLA and Minnesota paid leave concurrently, as long as the reason for leave is a qualifying reason under both laws. So obviously, if the employee is absent for bonding time, a serious health condition, that's most likely going to be a qualifying event under both laws, and therefore you can require them to use it concurrently. Same thing with Minnesota Parental Pregnancy Leave Act. This is the Minnesota law where parents are entitled to 12 weeks of unpaid leave after the birth of a child, and you can require this leave and paid leave to run concurrently. Again, if the reason for leave is a qualifying reason under both. And then just to reiterate, Minnesota Earned Sick and Safe Time, this is a paid leave benefit, so you cannot require employees to use it concurrently. You can only offer it as a supplemental benefit, and then employees have the option to either accept it or reject it and save that sick time from when they come back from Minnesota paid leave. Now, your policies in your handbook, we would recommend that your Minnesota paid leave policy states that if you have a qualifying reason, and it's a qualifying reason under both the federal FMLA and the Minnesota Parental and Pregnancy Leave Act, then employees must use it concurrently. So we highly recommend that you would include that language in your handbook to avoid employees stacking them. So notice requirements. So employers have two notice requirements. They have a poster requirement and then an individual employee notice. So these notice requirements had to be satisfied by December 1st of last year. So you have to display a poster in the workplace that basically summarizes employees' rights under paid leave. And thankfully, there is a model poster online on the Minnesota paid leave website. So you just go online, print it off, and you can post it in the workplace. And it basically has to be posted in a location that can be seen by every employee. So essentially a break room or any other room where most employees visit throughout the day. And then you also have to give notice to employees of their rights under Minnesota paid leave. And again, there is a template notice that employers can print online and you can give it to your employees. Now, with that template notice, employees have to provide a physical or an electronic signature that acknowledges that they received that notice. So this template notice online, there is a signature block already built into it. So there's a spot for employees to sign and then return it to the employer. So the poster obviously has to be in English. And then if you have 5 or more employees or independent contractors that speak a language other than English, then you have to provide the poster in that language to those employees or independent contractors. And on the Minnesota Paid Leave website, I think they literally have the poster in dozens of languages. So most likely the language you're looking for will be online. So the individual employee notice, again, you had to give it to your current employees by December 1st of last year. And then if you hire any new employees after December 1st, 2025, you have to give them that notice within 30 days of their hire date. And again, this template notice is online, so you can just print it off, give it to your employees, your current employees or new hires, and just make sure they provide a physical signature or an electronic signature. So there are some legal remedies if you violate an employee's Minnesota paid leave rights. So just be aware of that employees can sue for damages and they can be entitled to attorney's fees and the costs they incurred filing the lawsuit. And then employers can be fined between $1,000 to $10,000 for each violation, depending on the severity and the frequency of the violations. So it does have a bit of teeth if you do violate it. Okay, so the private equivalent plan. So as we're talking about this and you think, hey, the state-run program sounds like a terrible idea. I don't want to participate in this. There is an alternative. Now, you can't opt out of Minnesota paid leave, but you can get a private plan, a private insurance plan, if you don't want to participate in the state plan. So the private plan, it can be through a third-party insurer. You can be self-insured, or you can buy a pre-approved plan online. In the Minnesota paid leave, they have a list of approved plans on their website. So you can just call the number for each insurance company, say you want to purchase a plan, and then they can get you set up. Alternatively, if you want to use a different insurance company, you can submit a application, and you submit an application to Minnesota paid leave. They review it, and then once they approve it, you now have a private plan and you don't have to participate in the state plan. But with the private plan, there are obviously certain requirements that you have to comply with. So the first being that the private plan has to provide equal or better benefits than the state plan. So it has to be as favorable or more favorable than the state plan. So under the state plan, employees get 12 weeks of medical leave. The private plan can't say employees only get 10 weeks. It has to be at least 12 weeks or more. And then throughout the entire plan, it just has to be as favorable as the state plan. So kind of like earn sick and save time, if you have a PTO policy, you just have to satisfy the minimum requirements, but you can always go above and beyond and provide more benefits to employees. And another big one is that participating in the private plan cannot cost employees more than what they would have paid under the state plan. So basically, they can't have higher premium rates under the private plan. And then the private plan, once it is approved and once you do roll it out to your employees, you're locked in for 1 year. So you have to do it for at least one full year, whereas in the state plan, you can opt out anytime in any quarter. But the state plan, you have to do it for at least 1 year before you change it. And obviously, the private plan has to cover both family leave and medical leave, or it could do just family leave and then you participate in the state program for medical leave or vice versa. And another big one is that if you have a private plan, you have to continue to offer coverage to former employees up to 26 weeks post termination or until the employee receives a new job. So you have a private plan, say you fire someone, and that person does not get a new job within 26 weeks, they can still, kind of shockingly, still submit a claim and receive paid leave payments from the insurance company because they're within that 26-week window. Now, the private plan, the big thing is that you don't have to pay premiums to the state, but you still have to submit the quarterly wage reports. So the goal of the private plan for most clients I've talked to is obviously to make it cheaper and more affordable. So you don't have to pay the premiums to the state, but you still have to do the quarterly wage reports because the state wants that information just to make sure, like, hey, if you opt out of the private plan and you now want to do a state plan, they still have all the information for those employees. So again, you can be fully insured, self-insured, or you can buy a pre-approved plan online. So the deadline to submit a private plan, if you wanted a private plan effective in January of this year, you had to submit it by November, I think 15th or 25th of 2025. So obviously that deadline has passed, but you can still submit your applications throughout the year. So you can submit at any time because the state will approve those plans on a rolling basis. So if you want a plan to start next quarter, you can submit it this quarter. And then once the state approves it, or once you buy a plan, it will then go into effect in the next quarter of the year. But remember, once it gets approved and you implement it, you are locked in for a year and you can't change it for at least 1 year. Important dates, that December 1st deadline, you had to notify your employees of their rights under Minnesota paid leave. Again, that would be the employee written notice and then posting the poster in the workplace. January 1st is when paid leave obviously started. So payroll deductions began and employees are now eligible to go on leave. And then April 30th, 2026, that's when that first wage report will be due and the first premium payments will be due as well. So what to do next? So here's some action steps to make sure you're compliant as we're about a month into paid leave. So make sure you have both of your accounts. So make sure you have your joint UI paid leave account or paid leave only account on the UI website. So the employer account. Make sure you have your paid leave administrator account. And that's again on the paid leave website. But on the UI website, that's where you designate the paid leave administrator. And once you designate that person, then you create the paid leave account on the paid leave website. Notify your employees. So make sure you have that workplace poster posted in the workplace that can be seen by every employee. Make sure you send that written notice to employees. So just all your employees generally. And then the notice requirement if you intend to classify certain employees as seasonal employees and therefore not eligible for paid leave. And then your policies, decide how you're going to split the premiums. Again, most employers is going to be 0.88%. So decide how you're going to split that with the maximum of 50% from the employee. So most clients are just doing the 50-50 split where the employer pays 0.44% and then the employee pays 0.44%. Notification process, your policy should tell employees of if you're going to request paid leave, who can you contact at the company to request that? So who can they email? Who can they call? Is it a certain person they contact? Is it a certain department? Just making sure you spell that out so employees know, hey, before I apply for paid leave, I need to notify the company. And after that, they can submit their application if foreseeable. And then decide whether you want to offer supplemental benefits. So your Minnesota paid leave policy should clarify whether PTO, earned sick and safe time, vacation time, whether those types of leave will be offered as a supplemental benefit. Again, to supplement the paid leave benefit to get up to 100% of the employee's weekly pay. So you can offer it or you can decide not to offer it, but your policy should clarify that. And then you should also clarify your intermittent leave policy in your handbook. So decide the increment amount, the block of time they can use intermittent leave or paid leave. So up to 1 day, as low as 1 minute. Again, I would recommend matching it to the increment time you use for earned sick and safe time. And then decide how much leave can be taken intermittently. So employees have to be allowed to use at least 12 weeks or 480 hours of intermittent leave. And then from weeks 13 to 20, the employer decides of this leave between weeks 13 and 20 must be used intermittently, or you can allow employees to use it continuously. Your policy can decide that. All right. So I know that's a lot of information. So thank you for attending. Please let us know if you have any questions. We're here for you in the Compliance Center. So we actually have template policies that we give to all our clients for Minnesota paid leave. So we have a template policy for those participating in the state-run program, and we have a template policy for those participating in a private insurance plan. So just let us know if you want those templates or if you want us to review any of your policies. And of course, if you have any questions about Minnesota paid leave, you can call us or you can submit a ticket and we'll be happy to work through that with you. So again, thanks for watching, and I hope everyone has a great rest of their day.